You know, there's just something absolutely undeniable about the psychological pull of a massive dividend yield.
Oh, absolutely. It's like a magnet.
Right. Like when you look at your investment portfolio and you see a stock promising to pay out, I don't know, 15%, 20%, or even in some of the wilder corners of the market, like 60% a year, it creates this very specific kind of financial fantasy.
Yeah, you start doing the math in your head immediately.
Exactly. You think, if I just put my money here, I have found the ultimate wealth building shortcut. Like thousands of dollars just dropping into my account every single month purely for existing and holding onto a stock ticker.
Which is obviously a very dangerous mindset.
It really is. And well, welcome to today's deep dive,
Hmm.
because today we are unpacking this really fascinating financial analysis document that puts this exact fantasy to the ultimate test.
Yeah, the data here is incredibly revealing.
It is. So
Hmm.
our mission today for you listening is to run a one-year, $100,000 stress test on a few different dividend investments. And we're trying to answer a pretty simple but vital question, which is, does chasing the absolute highest payout actually leave you with the most money?
And, spoiler alert, the highest dividend on the screen rarely translates to the most secure investment.
Right.
In reality, some of the biggest payouts on the market come chained to just, well, catastrophic underlying risks. Today's simulation demonstrates that while some dividend checks are, generated by highly durable businesses, others operate on these mechanisms that actively destroy your initial capital just to keep that payout flowing.
I always like to think of a sky-high dividend yield like a giant, buzzing, glowing neon sign outside a roadside diner.
Okay, I like that analogy.
Right, because sometimes that sign is pointing you toward a fantastic, hearty meal, but other times it is shining at maximum brightness, specifically to like blind you to the fact that the roof is caving in and the kitchen is quietly falling apart.
Exactly. The neon sign distracts investors from inspecting the foundation of the building. And that really sets up the framework of the $100,000 simulation we are exploring today.
So what are we looking at exactly?
Well, we are looking at a spectrum of income investments. So we start with a modest yield that, honestly, aggressive investors usually just ignore, and then we move into the middle ground, and finally we test a payout so large it almost looks like a typo.
Right, and we're tracking exactly what happens over a 12-month period to see which underlying business model actually preserves and grows your initial wealth.
Yeah, the results are definitely going to surprise some people.
So before we jump into those massive slashy numbers, we need to establish a baseline. We are going straight to the smallest pair on our list, a stock that a lot of yield chasers would honestly just scroll right past on their brokerage app.
Yeah, they wouldn't even give it a second glance.
Exactly. The company is called Realty Income, and they offer a dividend yield of around 5.5%.
Which, in a market where people are clipping on promises of double-digit returns, 5.5% feels pretty slow.
It feels boring.
It is boring, but we have to look mechanically at how that money is actually generated. Realty Income is a massive real estate investment trust.
Basically a giant corporate landlord. Right.
Right. They own thousands of commercial properties across the United States and internationally.
And the source notes their secret weapon isn't just, accumulating random physical buildings. It is the structure of their leases and the consistency of their tenants.
Yeah, that's the key.
They lease these properties to well-known businesses like pharmacies, grocery stores, hardware chains, companies that have to keep paying rent regardless of whether the broader economy is in a massive boom or a terrifying slowdown.
Exactly. The underlying engine generating the cash for your dividend here is highly predictable rental income, and they use what are known as triple net leases.
Wait, triple net, what does that actually mean for them?
So it means the tenant is generally responsible for paying the property taxes, the insurance, and the maintenance.
Oh, wow, so the tenant covers all the annoying parts of owning property.
Exactly. Realty Income is mostly just sitting back and collecting the check. And that creates this beautifully insulated cash flow stream. I mean, for over 3 decades, this company has increased its dividend year after year.
30 years.
Yeah, 30 years. Think about the macroeconomic shocks of the last 30 years. We've had recessions, a global financial crisis, inflation spikes. To survive all of that without ever stopping those payments, it requires a kind of structural stability that very few corporate entities actually possess.
Okay, so let's run our simulation. If you took $100,000 and you put it into Realty Income for 1 year, the dividend alone generates roughly $5,400 in pure income.
which is pretty solid.
Yeah, it breaks down to about $450 every single month.
Yep.
And you didn't have to sell a single share of your stock to get it.
Right.
Plus, over this specific one-year test period, the stock price itself actually moves slightly higher. So when you add the capital gains to the dividends, your original $100,000 grew to roughly $110,000.
So you are looking at a 10% total return. And total return is really the crucial metric here.
Not just the yield.
Exactly. It's the cash income you receive plus the capital growth or, loss of the underlying stock. This investment quietly delivered the core philosophy of dividend investing, which is capital preservation paired with steady income.
Okay, I have to push back here a little bit, though.
Go for it.
Because if you are a hungry investor, eager to build wealth, a 5.5% yield still feels like you are crawling toward the finish line. And this company isn't invincible, right? Like the source points out a major risk factor for them, which is higher interest rates.
Yes, definitely a risk.
When rates go up, borrowing money to buy new properties becomes significantly more expensive. So, how much longer can a real estate giant realistically keep growing when the sheer cost of borrowing is eating right into their margins?
No, that's a very fair point. The pressure from rising interest rates is a severe headwind for literally any real estate trust. Real estate basically relies on the spread between the cost of capital, so what it costs them to borrow money, and the cap rate, which is the return they get from a property.
Right, the profit margin.
Exactly. If borrowing costs spike from, say, 3% to 6%, their profit margins shrink dramatically, and analysts are actively questioning their future growth speed under these tight monetary conditions.
Which makes sense.
It does. However, the $100,000 test proves that even while facing those macroeconomic headwinds, the underlying business was healthy enough to hold its value, pay the dividend, and still deliver a positive total return.
All right, so I want to pose this directly to you, the listener. Think about your own financial psychology for a second. Would you be content with a quiet, reliable, deeply unflashy $450 a month? Or would the temptation to see a bigger number in your account make you keep scrolling, looking for a faster way to build your portfolio?
And human nature often dictates that people just keep scrolling.
We always want more.
Always. And that desire to accelerate the process leads investors straight into our next category, which we can call the tempting middle.
Yes, the tempting middle. Because when you scroll past 5.5%, you land on our second test subject, which is Main Street Capital.
Right.
We are looking at a dividend yield here that sits close to 9%. So we have almost doubled the payout. Suddenly, instead of $450 a month, your $100,000 investment is promising almost $720 every month.
It's a big jump. But the fundamental mechanics of how that money is made shift entirely. Main Street Capital is a business development company, or it's commonly referred to as a BDC.
Okay, a BDC. How is that different from what we just talked about?
Well, instead of owning physical buildings and collecting rent, they lend money to medium-sized businesses. These are companies that often just cannot easily secure financing from traditional Tier 1 banks.
Wait, why can't these businesses just walk into a major bank and get a loan? Why do they need a BDC in the first place?
So following the 2008 financial crisis, there were massive regulatory changes that forced traditional banks to become highly risk-averse.
Ah, okay.
Yeah, they pulled back heavily from lending to middle-market companies. And BDCs basically stepped into that void to provide bespoke, flexible financing.
There's a catch,
A
right?
huge catch. Because they are lending to mid-sized, often less proven companies, they take on significantly more credit risk. And to compensate for that risk, they charge much higher interest rates on their loans. That high interest is exactly what funds the 9% dividend yield.
So you are no longer relying on, like, a multinational pharmacy chain paying rent on a physical building. You are depending on smaller businesses to keep making high-interest loan payments.
Exactly.
If the economy slows down and those borrowers start to struggle, the lender struggles right alongside them.
Yeah, the risk profile is elevated quite a bit. If a recession hits, mid-sized companies are often the very first to face cash flow issues and, default on their debt.
Which is scary.
It is. And opinions on Main Street Capital are heavily divided in the financial sector. Some analysts view it as one of the best managed BDCs available, but others argue that its portfolio is highly vulnerable to economic contraction. In fact, the source highlights noticeable short seller interest betting against this stock.
So professional investors are actively borrowing shares to bet that this company's value is going to plummet.
Yes. It is a glaring indicator that the market sees vulnerability. When short sellers target a stock, they are betting that the underlying assets, the loans the BDC has made, are going to degrade in quality.
Okay, so let's run the $100,000 test on this one. We put the money into Main Street Capital for a year. The dividend performs exactly as advertised, producing almost $8,600 in cash.
Sounds great so far.
It does. You are seeing those massive deposits hit your account. But while you were distracted by the neon sign of that 9% yield, the share price of the stock moved aggressively in the opposite direction. It fell by nearly 13%.
Yeah, and that is where the math catches up with you. The decline in the stock's price erased more value than the dividend could ever replace.
Ouch.
Yeah. This introduces the concept of net asset value, or NAV, decay. Basically, when the market believes a BDC's loans are at risk, the overall value of the company drops.
It's like going to a dealership and buying a car just because they offer you an amazing $8,600 cashback rebate.
That's a great way to look at it.
Right. You feel like a genius walking out with that giant check. But the literal second you drive the car off the lot, the vehicle itself depreciates by $13,000. You didn't make money, you actually lost it.
Exactly.
Doesn't this perfectly illustrate how a high dividend can act as a smokescreen for a declining asset?
It is the textbook definition of a yield trap. The company is handing you a large dividend, sure, but your principal investment is shrinking much faster than the cash is coming in.
Right, because you finished the 12-month simulation slightly below where you started. Even after collecting every single dividend payment, the total value of your investment dropped to around $96,000. You lost $4,000 of your principal.
Which proves that dividend income alone provides zero protection if the underlying health of the business is deteriorating.
Okay, so if jumping to a 9% yield forced us to take on enough risk that we actually lost money for the year, basic common sense tells us that going even higher would be absolute financial suicide.
You would think so, yeah.
Which brings us to the dangerous extreme. Our third test subject is a company called AGNC Investment, offering a dividend yield close to 14%.
14%. So that means your $100,000 investment generates well over $13,000 in annual income.
Over $1,000 every single month.
Right.
But the business model is entirely different from the first two. AGNC operates as a mortgage REIT. They don't own office buildings, and they aren't lending money to mid-sized businesses. They invest in mortgage-backed securities.
Yes, and according to the source, these investments are intensely influenced by interest rates.
Right, so we need to break this down mechanically. How does a company actually afford to buy enough mortgages to pay a 14% yield?
Okay, so mortgage REITs operate on leverage. They borrow massive amounts of money using short-term loans, often on the overnight lending market.
Okay.
And then they take that borrowed money and purchase long-term assets, specifically mortgage-backed securities that pay a fixed interest rate. So their profit is the spread.
The spread.
Right. It's the difference between the really low rate they pay to borrow the money and the higher rate they receive from the mortgages.
So just to make sure I'm getting this, if they borrow money at 3%, and the mortgages pay them 6%, they capture that 3% difference and just pass it to the investor.
Precisely. But the risk lies entirely in interest rate volatility.
Because rates change.
Exactly. If short-term borrowing costs suddenly spike to, say, 5 or 6%, but their long-term mortgages are still only paying them 6%, that profit spread vanishes instantly.
Oh, wow.
Yeah. And if borrowing costs exceed the yield of their assets, they are actively bleeding cash.
Which explains their historical track record then. Because the source details years of a downward trending share price and repeated dividend reductions. When conditions got tough, they literally cut the investor's pay.
Yeah, when interest rates rise rapidly or even just unpredictably, their highly leveraged model suffers severe damage. The share price drops, and they are forced to reduce the dividend just to survive the margin squeeze. Any conservative investor looking at a 14% yield attached to a history of dividend cuts should immediately recognize the structural danger there. I mean, everything we established about the yield trap with Main Street Capital suggests AGNC should be a total disaster.
Okay, so we run the $100,000 test on AGNC Investment for 1 year, fully expecting a complete train wreck. Dividend pays out nearly $14,000. And then, no ellipses, let me rephrase that. And then the share price doesn't drop.
Right.
Against all historical trends and fundamental warning signs, the share price actually climbed by roughly 12%.
It is a completely counterintuitive outcome.
It's crazy. When you add the massive $14,000 dividend to the 12% capital gain, the investment finished the year worth around $126,000, a 26% return in 12 months.
Which is massive.
I have to stop here and challenge the entire premise of our discussion. You just explained how fragile and leveraged this model is.
I did, yeah.
This is like going to the racetrack, finding a horse with a visible limp and a history of coming in last, betting your life savings on it, and it somehow wins the Kentucky Derby.
That's exactly what happened here.
So if the absolute riskiest stock on our list gave us a $26,000 profit in a single year, why shouldn't an investor just chase the massive yield? Why did it go up if the model is so flawed?
Okay, so the stock went up because financial markets are forward-looking and heavily driven by sentiment. During this specific 12-month window, investors began anticipating that the central bank was going to stop raising interest rates and eventually start cutting them.
Expectations.
Right. Remember the spread we discussed. If the market believes borrowing costs are about to fall, they forecast that the mortgage REIT's profit margins will expand in the future.
Got it.
So investors flooded into the stock, bidding up the price based on an expectation of future economic conditions.
So it wasn't a structural improvement in the business itself at all. It was just the market placing a massive bet on what interest rates might do next.
Exactly. It is entirely based on market timing and variance. The danger here is confusing a speculative short-term trade with a reliable long-term investment strategy. One incredibly profitable year driven by shifting interest rate sentiment does not erase a structural history of repeated dividend cuts.
Right.
Highly leveraged, risky investments can have exceptionally lucrative years just as easily as they can have catastrophic ones.
But no one knows which version of the market they're going to get before they lock their money in.
No, of course not. If you require predictability and capital preservation, this isn't investing, it is speculating. The fact that the gamble paid off in this specific year does not validate the strategy for someone trying to reliably compound their wealth.
It's just luck, basically.
The risk of absolute ruin is simply too high when you are relying on highly leveraged vehicles to constantly navigate shifting economic winds perfectly.
Okay, so what does this all mean for you listening right now? Let's quickly recap the journey we just took. We started with the reliable tortoise of the group, Realty Income, a modest 5.5% yield backed by the dull consistency of commercial rent.
Very dull, very reliable.
Yeah, it did make headlines, but it reliably grew the $100,000 to $110,000. Total return, preserved capital.
Then we moved into the deceptive middle ground with Main Street Capital.
Right, the yield trap.
Exactly. The yield jumped to 9%, the underlying mechanism shifted to high-risk lending, and the vulnerability increased. We collected a large amount of cash, sure, but the NAV decay was so severe we ended the year having lost money, sitting at $96,000.
And finally, we analyzed the unpredictable wild card, AGNC Investment. A massive 14% yield, a historically terrible track record of dividend cuts driven by a highly leveraged mortgage spread model.
Yep.
But through sheer market sentiment and shifting interest rate expectations, it defied gravity and soared to $126,000. The core takeaway from the data today is that a dividend is only one half of the equation. The underlying mechanics of the business dictate your actual total return.
And you know, the source material actually leaves off on a really fascinating cliffhanger.
Oh, that's right.
Yeah, the document teases that the next two investments become even more interesting, although we unfortunately don't have the data to run the simulation on them today.
But that actually brings us right back to the very first paragraph of the text we analyzed today. The source mentioned stocks that promise 20% or even more than 60% a year.
Which is just astronomical.
It is. Think about the progression we just walked through. If a 14% yield requires navigating a terrifying history of dividend cuts, leverage borrowing, and price swings that resemble a casino, what kind of structural catastrophe must be quietly lurking inside a company offering a 60% yield?
It's a terrifying thought.
Next time you see a glowing neon number that looks like a magic shortcut to wealth, ask yourself, what exactly are they trying to distract me from?